Hey guys, welcome back to another brand new video and thanks so much for tuning in. Today I'm looking at 3 of the most commonly used ratios that investors use when they're looking into buying dividend paying stocks that can help them determine whether or not these stocks are a good investment. I'm going to show you how these ratios can all be really easy to figure out and how you can apply them to any dividend paying company. So this is going to be a big help to you if you ever want to buy stocks that are going to pay you regular passive income in the form of dividends. I really hope you find the video helpful, and if you do, go ahead and let me know by hitting the like button, because that's going to show me which of these videos you enjoy the most, and I can then be sure to keep creating content that's useful for you in the future. So for anyone who doesn't know, dividend stocks are just like the stock of any other company, except that they pay out regular dividends to their shareholders. Dividend stocks are usually from well-established companies that have a history of paying a portion of their earnings back to shareholders in the form of dividends. This is in contrast to growth stocks, which are companies that don't tend to pay out dividends, but instead reinvest their earnings in an effort to grow the business and increase its value, which in turn increases the price of the stock. So when it comes to dividend stocks, many investors that are looking to buy them will use dividend ratios to try and figure out the dividends that a company might pay in the future. These ratios give an indication of a company's ability to pay out future dividends to its shareholders. And it's a good idea to use a combination of these ratios to make sure that you aren't just relying on one. The first of the dividend ratios is the dividend payout ratio. The dividend payout ratio can be calculated as a company's annual dividends per share divided by its earnings per share, or total dividends divided by net income. This information should all be freely available for listed companies, and you can usually find it just by doing a quick Google search for the company's annual or interim financial statements. But if you don't fancy going through a company's financial statements, then a really good free tool that I like to use when I'm looking at different stocks is Yahoo Finance. They tend to have a lot of the financial information on there that you'll need, so it's a really good place to go if you just want to find things quickly. The dividend payout ratio indicates how much of a company's annual earnings per share that company is paying out to its shareholders in the form of cash dividends. So if a company has a dividend payout ratio of 30%, that means that for every dollar it generates in net income, 30 cents of that dollar is paid out to its shareholders. Generally speaking, a company that pays out less than 50% of its earnings in the form of dividends is seen to be stable because it's keeping more than half of its earnings available to invest in its own future growth, which in turn then gives it the potential to increase its earnings over the longer term, which could then result in higher dividends for shareholders in the future. On the other hand, a company that pays out more than 50% of its earnings is going to be left with less than half of its earnings available to invest in its own future growth, which in theory then is going to make that company less likely to be able to grow and less likely to be in a position to be able to increase, or in some cases even maintain, its dividends in the future. So in general, a lower dividend payout ratio is seen as preferable to a higher ratio, because the higher the ratio, the more likely it is that the company could struggle to maintain its dividend payments over the longer term. This ratio can be a really handy statistic to look at, but it's always a good idea to compare it against the dividend payout ratios of similar companies or the industry average to see how the company that you're looking at compares against those. Next up is the dividend coverage ratio. The dividend coverage ratio is calculated by dividing a company's annual earnings per share by its annual dividend per share. And as I mentioned before, all of this financial information should be available online, so I'd recommend just having a quick look on Yahoo Finance, or otherwise a Google search should help you find it. The dividend coverage ratio shows investors the number of times that a company could theoretically pay its dividend out using the net income that it generated during the same period. Generally speaking, a higher dividend coverage ratio is seen as a better signal, because the higher the ratio, the more times over the company is able to pay its dividend, which shows that that company is then generating more than enough money to meet its dividend payments. So we've looked at the dividend coverage ratio and the dividend payout ratio, which are both really useful ways to evaluate dividend stocks. And now the third ratio is called the net debt to EBITDA ratio. This one does sound a little bit trickier to figure out than the other ratios, but as with the other ratios, all of the information that you could possibly need to figure this out is all going to be available online. So just have a quick look on Yahoo Finance or Google and you'll be able to find it in no time at all. The net debt to EBITDA ratio is useful because it measures a company's leverage, which is basically how much money it's borrowed, and its ability to meet or repay those debts. So the net debt part of this ratio is referring to a company's total liabilities minus its cash and cash equivalents. And the EBITDA part of the ratio is an acronym, and that stands for earnings before interest, taxes, depreciation, and amortization. So in order to calculate the net debt to EBITDA ratio, you need to take the company's total liabilities minus its cash and cash equivalents, and then divide that figure by the company's EBITDA. Generally speaking, a company with a lower ratio by comparison to similar companies or to its industry average is seen by investors as being a more attractive investment. And when a dividend paying company has a high net debt to EBITDA ratio that's been increasing over a period of time, this might be an indication that the company is not generating enough money to be able to sustain its current dividend and also meet its debt repayments at the same time. So it's quite possible that a company in that position could cut its dividend payment in the future in order to be able to then meet its debt repayments. So there you have it. I really hope you learned something new here, and do feel free to leave me a comment down below and let me know what you thought of today's video. Also, don't forget to give the video a thumbs up. It only takes a couple of seconds to do, but it really helps me out and it helps the channel to grow and reach more people too. I post a brand new video right here on the channel every single week. So if you want to be among the first to be notified when a new video drops, make sure you hit the subscribe button and also turn those notifications on by clicking the bell icon down below, and you're then going to be notified as and when new videos are released. Thanks so much for watching. I hope you have an amazing day, and I will see you right back here next time.